You have been investing for years, and you have been paying a tax you were never legally required to pay. Not because the IRS deceived you, not because you made a mistake, because nobody told you that a 0% capital gains tax bracket exists and that you probably qualify for it right now. Here is what that actually means. The U.S. tax code has a published rate for long-term investment gains, a rate that applies specifically to middle-income American earners, a rate that the financial industry almost never discusses with the people it was designed to help. That rate is 0, and according to the Joint Committee on Taxation, Americans who qualify for it paid $9.4 billion to the IRS in 2023 that they were legally not required to pay. $9.4 billion. Voluntarily. Because nobody showed them where to look. This video is going to show you where to look. Before we go further, 3 things I am going to show you that most financial content never covers. First, exactly how a couple earning $78,000 in Boise, Idaho, legally eliminated $24,000 in capital gains taxes. No financial advisor. No complex strategy. No additional income. Just one number on their tax return they had never checked before. Second, the exact cognitive bias identified by a Nobel Prize-winning economist that causes Americans to pay billions in taxes they do not owe. Once you understand the mechanism, you will never fall for it again. Third, one number on your 2026 tax return. One number that tells you immediately whether you qualify for the 0% bracket this year. You can find it in 60 seconds. Let's start with what you probably believe right now. You have a brokerage account, maybe at Fidelity, maybe at Vanguard or Schwab. You have been contributing consistently. VTI, FAIX, a target date fund. The balance has grown. You feel good about that. And somewhere in the back of your mind you carry a quiet assumption. When I eventually sell, I will pay taxes on those gains. That assumption feels responsible. It feels like the correct mindset for a patient, long-term investor. That assumption is costing you thousands of dollars a year that you will never recover. The TA Institute measured this in their 2025 financial literacy study. Only 13% of American adults correctly identify that long-term capital gains are taxed at a different and lower rate than ordinary income. 13%. That means 87 out of 100 Americans are making sell and hold decisions based on a fundamentally false understanding of how their investments are actually taxed. Long-term capital gains, gains on investments held more than 1 year, have their own separate rate structure. 3 tiers. And at the bottom sits a rate almost nobody discusses with middle-income Americans. 0%. In 2026, the 0% long-term capital gains rate applies to taxable income up to $49,450 for single filers. For married couples filing jointly, the threshold is $98,900. The IRS confirmed these numbers in Revenue Procedure 2025-40. The Tax Foundation independently verified them. This is not a loophole. This is not aggressive tax planning. This is a published bracket in the U.S. tax code, available to any American who earns below the threshold and chooses to use it. The critical word is taxable income. Not your gross salary, not your W-2 total. Your taxable income, after the standard deduction of $16,100 for single filers and $32,200 for married couples in 2026. Run the numbers with me. A single teacher earning $52,000 has taxable income of approximately $35,900 after the standard deduction. The 0% threshold is $49,450. That teacher has $13,550 of capital gains she can realize this year at 0 federal tax. A married couple earning $85,000 combined has taxable income of roughly $52,800 after deductions. The 0% married threshold is $98,900. That couple has over $46,000 of gains they can harvest this year, completely tax-free. and the Tax Policy Center estimates that 28 million U.S. households qualify for this bracket in any given year. 28 million families. The overwhelming majority never use it. Why? The answer is not simply a lack of information. The answer is a documented, named, academically verified cognitive mechanism that your brain runs automatically, and that costs you money every single year you do not consciously override it. The mechanism is called status quo bias. William Samuelson and Richard Zeckhauser named and documented it in the Journal of Risk and Uncertainty in 1988. Nobel Prize winner Richard Thaler later extended it into financial behavior specifically. Status quo bias causes human beings to treat inaction as the safe default, even when action is mathematically superior, legally costless, and permanently beneficial. For investors, the status quo is hold. Never sell. Let it compound. That instinct built your account. It is also the reason you leave the 0% bracket completely unused year after year. The second bias working against you is tax anxiety. The word taxes triggers avoidance. Most people do not engage with their brokerage accounts because they fear generating a tax event. That protective instinct, the one that feels like financial responsibility, is the exact mechanism preventing you from discovering that the tax event in the right year costs you nothing. Fear of the wrong thing, that is the trap. And it is entirely predictable once you understand it. There is a structural reason the financial industry never corrects this. The clients who most benefit from 0% bracket harvesting earn between $40,000 and $75,000 per year. Those are precisely the clients financial advisors cannot profitably serve. A 1% AUM fee on a $50,000 account generates $500 annually. 1 hour of proactive tax planning is not economically viable at that fee level. So the conversation never happens. Vanguard's 2022. Advisors Alpha Research quantified the tax planning value at 0.7% annually, but that value only reaches you if someone explains the strategy. The clients who receive sophisticated tax planning are the clients who least need it. The middle-income investor is structurally left out, not through malice, but through economics. So here is the conversation your advisor is not having with you. The strategy is called gain harvesting. It is the legal, rational inverse of tax loss harvesting, and almost no one discusses it. Here is exactly how it works. Step 1. Calculate your estimated 2026 taxable income before December 31st. Use your most recent pay stub. Annualize your W-2. Subtract the standard deduction, $16,100 single, $32,200 married. Step 2. Compare that number to $49,450 single or $98,900 married. Step 3. The gap between your taxable income and the threshold is your 0% harvesting room. Step 4. Log into your taxable brokerage account at Fidelity, Vanguard, Schwab, or Robinhood. Identify your most appreciated position. Sell shares up to your harvesting room amount and gains. Step 5. Immediately repurchase the same shares at the new higher price. That last step is the one that stops people. It sounds too clean. Here is why it is completely legal. The wash sale rule, the IRS provision preventing you from selling a loss and immediately rebuying, applies only to losses. IRS. Publication 550, updated in 2025, is explicit. The wash sale rule does not apply to gains. You can sell VTI, recognize the gain, pay zero federal tax because your income qualifies, and immediately repurchase VTI at the new higher cost basis. You have permanently eliminated that gain from your future tax liability. The IRS permits it. Your brokerage executes it in seconds. Almost no one does it. And there is a second opportunity hiding inside the same tax year. A single filer with taxable income of $30,000 has two windows open simultaneously. First, $19,450 of 0% capital gains harvesting room in their taxable brokerage. Second, space below the 22% marginal bracket for a Roth IRA conversion, moving pre-tax dollars from a traditional IRA or old 401k into a Roth, paying tax on the converted amount now at a lower rate than they will face in retirement. Running both strategies in the same year is legal, executable, and almost completely absent from mainstream financial content. Ifkovitz, Poterba, and Weisspinner published the return data in the Journal of Finance in 2005. Tax-aware portfolio management, specifically harvesting gains during qualifying years, improves after-tax returns by 0.5% to 1.1% annually for middle-income households. On a $150,000 portfolio over 30 years, that 0.5% improvement adds $87,000 in terminal wealth. Not from better stock picks, not from market timing, from knowing which year to sell. Now I want to tell you about Marcus and Diane. Marcus teaches high school history in Boise, Idaho. He earns $52,000 a year. His wife Diane works part-time as a dental hygienist, earning $26,000. Combined income, $78,000. They have a taxable brokerage account at Fidelity, mostly VTI, purchased between 2015 and 2019, at an average cost of $9,800. By 2025, that position had grown to $34,000. They were sitting on $24,200 in unrealized gains. Their combined W-2 of $78,000, minus the standard deduction of $32,200, gave them taxable income of $45,800. The 0% married threshold is $98,900. They had over $53,000 of harvesting room. They could have harvested every single dollar of those gains at zero federal tax. They did not. Not because they were careless, because their tax preparer, a local CPA who filed their return in 45 minutes for $180, never mentioned it. The CPA filed accurately. He optimized for compliance. He did not optimize for wealth. That distinction, between a preparer who files correctly and a planner who thinks ahead, is one of the quietest wealth transfer mechanisms in American personal finance. The $180 tax return is priced for accuracy. It is not priced for strategy. If Marcus and Diane had harvested $4,100 in gains annually for the prior 5 years, they would have permanently eliminated $20,500 in taxable gains. At the 15% rate they will face in retirement, that represents $3,075 in avoided taxes every year, compounding forward into something significantly larger. After learning the bracket exists, Marcus ran the calculation himself. It took him 20 minutes using their prior year tax return. They harvested $4,100 in gains that December at zero tax cost. They will do it every November going forward. One calendar reminder. 20 minutes. $0 spent. Now I want to tell you about Priya. Priya is a UX designer in Austin, Texas. She earns $47,000 per year. In 2025, she took a 3-month unpaid sabbatical, her first real break in 7 years. Her annual W-2 income dropped to $35,250. After the standard deduction, her taxable income was $19,150. Her 0% capital gains harvesting room was $30,300. She had $7,200 in unrealized gains inside her Fidelity account, mostly fakes, purchased automatically every month for 5 years. She had a $30,300 window to eliminate every dollar of those gains from her future tax liability at zero cost. She did not know. She avoided her brokerage account entirely during the sabbatical, not from laziness, from anxiety. Money felt tight. Looking at the account felt threatening. The 3 months that created the largest tax planning opportunity of her investing life were experienced entirely as financial stress and avoidance. This is the availability heuristic, the cognitive shortcut where the emotional weight of a concept determines how your brain processes it. Taxes feel dangerous. Danger triggers avoidance. Avoidance prevents you from discovering that the thing that felt dangerous was actually the opportunity. The emotion and the optimal financial action pointed in exactly opposite directions, and the emotion won. Priya now sets a calendar reminder on November 1st every year. She checks her estimated taxable income. She compares it to $49,450. She calculates her harvesting room. That is the entire system. One reminder, 20 minutes. It permanently changed her relationship with her taxable brokerage account. 3 more things before the action plan, and this is where it gets genuinely surprising. The OBBA, the One Big Beautiful Bill Act, signed July 4, 2025, permanently indexed the 0% capital gains bracket to inflation. Before 2025, there was real political risk. This bracket could be modified or eliminated. That risk is now removed. This is the most stable, predictable window to build a multi-year gain harvesting strategy that has ever existed in U.S. tax history. The years that feel most financially threatening are almost always the most valuable for tax planning. A sabbatical, parental leave, a business startup year, a career transition. These are the years taxable income drops and 0% bracket room expands. These are also the years most Americans experience as anxious and avoid engaging with their finances. The year that feels the most threatening is usually the year that is the most valuable. Every time. And this one will genuinely surprise you. Actively managed mutual funds inside your taxable brokerage account are silently consuming your 0% bracket headroom, without your knowledge, without your consent, and without your action. Here is the mechanism. When a fund manager inside your mutual fund sells a position, every shareholder in that fund receives a capital gains distribution, whether you sold a single share or not. Morningstar's 2023 analysis found the average actively managed equity fund distributed 6.2% of NABEV as capital gains to taxable account holders. On a $100,000 position, that is $6,200 in forced taxable gains, consuming $6,200 of your 0% bracket room every year, automatically, silently, regardless of any decision you made. VTI on Vanguard, FEIX on Fidelity, SWTSX on Schwab. These index funds generate near zero capital gains distributions because their portfolio turnover is minimal. Switching from an actively managed fund to any of these inside your taxable account does 2 things simultaneously. It stops the involuntary distribution problem, and it preserves your entire 0% bracket for strategic annual harvesting. The fund you hold and the tax bracket you use are the same decision. Almost no one connects those 2 facts. Here is your action plan. By income level. If you earn $50,000 as a single filer, your taxable income after the standard deduction is approximately $33,900. You have $15,550 of 0% harvesting room. Log into your taxable brokerage before December 31st. Find your most appreciated position. Calculate the unrealized gain. Sell up to $15,550 in gains. Immediately repurchase. Pay 0 federal capital gains tax. If you hold actively managed funds, move them to FEIX on Fidelity, VTI on Vanguard, or SWTSX on Schwab this week. That single move stops the silent bracket drain permanently. If you earn $100,000 as a married couple, your taxable income after deductions is approximately $67,800. You have $31,100 below the married 0% threshold. Use part of that room for gain harvesting in your taxable account. Use part of it for a Roth conversion from your traditional IRA or old 401k. Run both strategies in the same tax year. Confirm the numbers with TurboTax or a fee-only CPA before executing. But the framework is sound, it is legal, and it is available to you right now. Regardless of income, do this today. Pull your most recent pay stub. Estimate your 2026 W-2 income. Subtract your standard deduction. Compare the result to $49,450, single, or $98,900 married. The gap is your 0% harvesting room. Write that number down. 20 minutes. Zero cost. The 20 most valuable financial minutes of your year. Now let me close the 3 things I promised you at the start. Marcus and Diane in Boise harvest gains every December. Their CPA still files their return for $180. He still does not mention the strategy. They find it themselves, because now they know where to look. That is exactly what this video is for. The cognitive bias is status quo bias, named by Samuelson and Zeckhauser, extended by Richard Thaler. The default is inaction. Inaction costs you nothing today and thousands of dollars in retirement. The IRS does not send you a refund for the tax you could have avoided. It collects the tax you failed to avoid. The bias makes inaction feel like discipline. The data shows it is the opposite. And the one number is line 15 on your Form 1040, your taxable income. Compare it to $49,450 single, $98,900 married. If you are below the threshold, you have harvesting room. That is the entire calculation. 20 minutes, zero cost. Do it before December 31st. The IRS did not hide this from you. The financial industry just never had a reason to show it to you. If this video changed how you see your taxable account, subscribe. Every video on this channel is built the same way. PhD level research. Strategies your advisor is not calling you to share. I will see you in the next one.